I just want to see whether this is now what I must do. Michelle, can you guys see the screen, legally speaking?
We can see it. We can see the slides. Hein, we can see the slides.
Beautiful. That's perfect. Okay. Good morning, everyone. Welcome to another session. Exciting times. Eskom is causing havoc. Morning, Bernie, and everyone. It's nice to see Bernie's name as well from EdgeMeet. So what we're going to do this morning is we're going to talk about the 5 big taxes that play a role in respect of maybe property transfers. We're going to have a look at VAT and transfer duty. We're going to have a look at capital gains tax and the retention for non-res sellers. We're going to have a look at estate duty and donations tax. So estate duty and donations tax doesn't play a part in your lives really that much, but we'll have a look. It's nice to have that knowledge. And if you get that question from a seller, then at least you can guide them to some degree as to what to do or where to go. So if we have a look, VAT and transfer duty, there's always either VAT or transfer duty payable in respect of the sale or the purchase of a property. So the point of departure is normally that the Transfer Duty Act is applicable and that the purchaser will have to pay transfer duty when he acquires the property from the seller. It's payable in all instances of acquisition unless it is exempt. So we will get to that. And one of those exemptions is transfer duty won't be payable if VAT is payable on the purchase price. So the way that I explain it is because it's either transfer duty or VAT that is payable, never both. You don't pay transfer duty as a purchaser and plus VAT on maybe the purchase price of a property. It's either or. It's never, ever both. So the question then is, but okay, that's great. But just give us a quick example as to, or an explanation as to how will we know when is transfer duty payable or when is VAT payable? So the example that I always use, because often the estate agents come to me and say, but Hein, the purchaser is registered for VAT. So is this a VAT transaction? Must the purchaser pay VAT because the purchaser is registered for VAT? The quick answer is no. You won't have to pay VAT because the test is, what I always use as an example. When you go to the Spar and you buy a loaf of bread or you buy a milk, you pay VAT because Spar, the seller of that product, whether it's a bread or milk, whatever, the seller is registered for VAT. So that determines whether VAT is payable in respect of the sale of a property. You're going to have a look whether your seller is registered for VAT. So that is your starting point to determine whether or not VAT or transfer duty is payable. If your seller isn't registered for VAT and your purchaser is registered for VAT, well, that's fine. Doesn't matter. Your purchaser will pay transfer duty because VAT is applicable if your seller is registered for VAT. So we'll get into a little bit more detail when we get to that. So VAT is applicable if the seller is registered for VAT. It doesn't matter whether the purchaser is registered or not. It's irrelevant. The seller must be registered for VAT because he is selling an item, whether it's a bread or a milk or whether it is an immovable house. He's registered as a VAT vendor, so he must charge VAT on that property. The transaction must also form part of his VATable business. Now, what does that mean, Hein? If your seller, when he purchased that property, he obviously paid transfer duty or whatever because when he bought the property, it was irrelevant that he, as the purchaser, is registered for VAT. It's irrelevant. He's going to pay transfer duty because his seller might not have been registered for VAT, which is fine. So if your purchaser then claims any VAT back on that property, then it forms part of the business of the seller, and then he must charge VAT. So another quick example is, I've got a friend, he's a doctor, he's registered for VAT in his personal capacity. So as a doctor, you register for VAT in your personal name, not in the name of a company, in your personal name. So Piet Pompies is a doctor, he registered for VAT so that he can claim VAT back from SARS on equipment and whatever he can claim VAT back, and he will charge VAT on his fees, etc., etc., etc. So Piet Pompies phoned me to say, Hein, I'm selling my property, my house, where I and my family stay there in Newlands, for argument's sake. I'm registered for that. I'm a doctor. I'm registered for that. I'm selling this property now. So I must probably just remember, I must now charge that when I sell this property. I said, Pete, no. Did you ever claim that back when you bought that house for you and your family to stay in? Did you ever claim that back from SARS? You could have, but did you? He said, no, I never claimed any VAT back. You know, I did renovations, I went to builders, I paid VAT, whatever, but I never claimed it back because it's my private residence. So I never claimed VAT back. So, Pete, then this property, despite the fact that you are registered for VAT, despite that, the second question is, did this property form part of your VATable enterprise or your business? And the answer is no, because you never claimed VAT back from SARS. So, Pete, on the sale of this property, you don't charge VAT. You don't have to pay VAT over to SARS because it never formed part of your VATable enterprise. So those are the two questions. When you want to know whether VAT is payable, is my seller registered for VAT? Okay, yes or no? If he is, well, that's great, but there's a second question. The second question is, Mr. Seller, okay, you are VAT registered, but did this property that you are now selling, did it ever form part of your VATable business? Well, how do I know that? Did you ever claim VAT back from SARS in respect to this property? No, I didn't. Well, then that is not applicable then, Mr. Seller. Your purchaser will just pay the normal transfer duty. There are also VAT exempt transactions. We will have a look at that. That is, for example, even if a developer, for example, buys flats and his business is he purchases residential properties to let out for residential purposes, he's not allowed to charge any VAT on that rental. So, meaning if he doesn't charge VAT, there's no VAT that he has to pay over to SARS. So there is no VAT payable, Mr. Developer, because if you let out residential properties, not commercial, properties for residential purposes, first of all, you are not allowed to charge any VAT on the rental that you are receiving. And in the circumstances, this properties doesn't form part of your VATable business because you never charged VAT on the rental. So, Mr. Developer, despite the fact that you are registered for that, that's fine, but you are selling properties where you couldn't charge or were not allowed to charge VAT on. So this doesn't form part of your VATable enterprise. So your purchaser, if you sell the property that you leased out, your purchaser will have to pay transfer duty. There are also zero-rated transactions. That gets a bit more tricky. That is, if your seller and your purchaser, if they are both registered for VAT, they can apply to SARS to zero VAT rated. SARS will zero VAT rated that no VAT is payable by the purchaser or the seller if the property is an income earning activity. So if it's a commercial property, for example, that's got a lease agreement of 10 years. So obviously it's commercial property, or a guest house or whatever, where the seller has charged VAT on rentals or income or whatever, and your purchaser is also VAT registered, and he just wants to take over the business. It's sold as an income earning activity, and it is sold as a going concern. the purchaser will just carry on with the business. If those criteria are met, SARS says, well then guys, don't purchaser, don't pay VAT, and the seller will then pay the VAT over to us, and it will be claimed back. So you know what? To avoid all that admin, let's just zero VAT rate it, just to avoid VAT having to be paid and having to be claimed back then by the purchaser at a later stage. So it just causes more admin for us as SARS. So that's why we will just zero VAT rate it. VAT inclusive or exclusive, it is very important, obviously, to put in your offer to purchase if that is applicable, if your seller is registered for VAT, if the property forms part of his VATable enterprise, then your offer to purchase must be clear as to whether the purchase price includes VAT or excludes VAT, because it will make a massive difference to a seller. If your seller comes to you and says, look, John, I want to sell my property. I'm a VAT vendor. The property forms part of my VATable enterprise, so I know I've got to pay VAT over to SARS. But, John, I want 600,000 Rand in my pocket. So then you, as John, the agent, must say, okay, I must then make the purchase price 600,000 Rand exclusive of VAT. So it doesn't include the VAT. So, Mr. Purchaser, you must know that you're going to pay 600,000 Rand plus 15% VAT thereon, because the purchase price excludes VAT. Because if you don't say it excludes VAT, it is deemed that it includes VAT. So then your seller will get his 600,000 Rand, but now because the offer to purchase didn't say that it excludes VAT, it is then deemed to include VAT. Your seller must then take 15% of that 600,000 Rand and pay it over to SARS. So your seller will come out, let's say, with 550,000 Rand. And then your seller is going to be the hell in with you, because he's going to say, but John, I told you, I want 600,000 Rand in my pocket. Oh, quit, I forgot to put that it excludes VAT and the purchaser must still pay VAT. It's a stuff up. So it's very important to get the wording right so that everybody understands where they stand and that the parties know what they need to pay, and that the seller get out what he wants to get out from the sale of that property. And then obviously that relates to VAT. There's also transfer duty. So obviously VAT or transfer duty, if VAT is not applicable to a transaction, so if your seller is not VAT registered and if the property doesn't form part of his VATable enterprise, then we must have a look at transfer duty, because Mr. Purchaser, then you might have to pay transfer duty. And then obviously, as you all know, you've got access to these sliding scales and the tariffs with regards to transfer duty. It's based on a sliding scale based on the purchase price of the property, and it is normally on the consideration paid. So if you've got an offer to purchase and the purchase price of the property is 2 million Rand, then it's very quick and easy to go and calculate what the transfer duty is, and the purchaser will pay it, the conveyancers will pay it over to SARS, and SARS will issue the transfer duty receipt that they need to lodge at the deeds office. Sometimes, however, SARS says, look, you can pay transfer duty as purchaser on the consideration on the actual amount of money that you paid, 2 million Rand or 2.5 million Rand for the property, that's fine. Or if we think that that is not the true value of the property, then you've got to pay transfer duty on the fair value of the property. So what this means is, let's say, for example, my brother decides he wants to buy my property in Cape Town. Let's say my property is valued at 2 million Rand. He then comes to me and he says, hi, come, I want to buy your property. I say, John, you know what? I'll sell it to you for 1 million Rand. So the offer to purchase says, I'm selling my property to my brother for 1 million Rand. So, and then no transfer duty is payable. SARS will say, no, hang on, guys. We're not now going to have a look at the actual consideration, the purchase price that Jean has to pay to get this property into his name. We want the estate agent's valuation. I don't care, SARS. I don't care whether you charge your brother 10 Rand, 1 Rand, 100,000 or 1 million Rand. We don't care. That's fine. You can do whatever you want to do. But your brother must just understand. He's going to pay transfer duty on the actual fair value of the property. So if SARS is of the opinion that there's a discrepancy between the actual value of the property and what the consideration is, SARS will say, no, guys, we want two estate agents' valuations to show us what is the market value of that property. Because despite the fact that you sold your property to your brother for R1,000,000, the actual value of the property is 2.5 million rand. So unfortunately, Jean will have to pay transfer duty on the actual fair value of the property. So he must still pay on transfer duty on 2.5 million rand. He's not going to get away with buying the property from you for R1,000,000 rand. That's a considerational payment, but that's not the fair value. So SARS has an option. They will always have a look at the consideration. What is the purchase price? And if they think, no, hang on, this purchase price is not reasonable, SARS can then come back to the conveyancers and say, hey, we see what the purchase price is, or the consideration. We see what that is. It's fine. But we want two estate agents' valuations because we are of the opinion that the actual value of that property is more than the R1,000,000 consideration that was in the contract, in the offer to purchase. And then obviously if the valuations come back from the estate agents to say the property is valued actually at 2.5, SARS will say, okay, that's fine. So now, Mr. Purchaser, you must pay transfer duty on 2.5 million rand. Despite the fact that the purchase price is R1,000,000 rand, that's fine, but you must still pay transfer duty on 2.5 million rand. So SARS will either use the consideration or the purchase price, or if they've got doubt whether this is a true reflection of the actual value of the property, they'll ask for two estate agents' valuations, and the purchaser will have to then pay transfer duty on the actual fair value of the property. There are certain transfer duty exemptions when doesn't matter what the value of the property is, there is no transfer duty payable to SARS. The two scenarios where that comes in is, for example, in an estate. So if I inherit a property from my mom or dad in terms of their will, let's say the property is 30 million rand, whatever the value, 100 million, a billion, doesn't matter. SARS says if you inherit a property, you do not have to pay transfer duty in respect of the transfer of that property from the deceased estate to you. Secondly, if you get divorced and one of the spouses get the property from the other spouse, there's no transfer duty payable to SARS. Doesn't matter what the value of the property is. So those are the two exemptions when there's no transfer duty payable. It's when you inherit a property or when a property is transferred to one of the spouses in terms of a divorce order. Then SARS does not require transfer duty at all. And the date when transfer duty becomes payable to SARS is the date of the sale of the property. So transfer duty must always be paid within 6 months after the date of sale. And if it's not paid within 6 months, then SARS can charge penalties on that amount that should have been paid to them. Very often an agreement is subject to certain things that has to be done and certain inspections, and that the transfer is going to be delayed by a year. We then advise the purchasers that it's fine that the transfer is delayed, but you have to pay the transfer duty within 6 months. You have to pay that. We have to pay it over to SARS. Otherwise, you'll be liable for the penalties as well if we pay the transfer duty in a year's time. Then the big one, capital gains tax. This is obviously the one that most sellers ask you guys about. And it's nice to have a little bit of knowledge and just get an idea as to what SARS requires from a seller of a property, because SARS requires, as from October 2001, if you make a profit, gains are made when you sell assets. SARS wants capital gains tax on the profits that you have made. And, we thought that it was very unreasonable, whatever tax SARS taxes for everything that we do, but it's international law. Capital gains tax has been applicable in other countries for so long, and we came on board in 2001. So SARS says, look, if you sell a property and you make a profit, then we're going to tax you on those profits. So whatever profits you make, a portion thereof will be included in your income tax. So capital gains tax is actually part of your monthly income tax or annual income tax that you pay, because a portion of your profits will be included in your income tax, and you'll be taxed based on your income tax bracket or income tax rate that you pay on your salary or whatever. That rate will now be applied to a portion of the profits that you've made when you sold an asset for a profit. So it basically forms part of your income tax. When is capital gains tax triggered? It's triggered when you sell a property for a profit, when you sell it for more than what the property cost you. The time of sale, if there are suspensive conditions in the offer to purchase, for example, the purchaser must get a bond or the purchaser must sell his property, then capital gains tax becomes payable when the suspensive conditions have been fulfilled. It's not the day that the property transfers at the deeds office that capital gains tax becomes payable. It becomes payable as soon as the offer to purchase is signed on that date, unless the offer to purchase is subject to suspensive conditions. Well, then it's not the date of the sale, it will be the date on which the suspensive conditions have been fulfilled. Then the liability arises, not on transfer. So if we have a look, for individuals, what SARS is saying is that you must take 40% of your net profits. So take 40% if you're a private individual, 40% of your net profits. So let's say you made R1 million net profits that you can put in your back pocket, net profits. Then SARS will say, well, then if you made R1 million net profit, take 40% thereof, so it's 400,000 Rand, and that 400,000 Rand will now be included in your taxable income. So whatever the rate of income tax is that you pay, you will pay whatever that rate is, 15, 20, 25, 30%, 45 of that 400,000 Rand. So a lot of people are under the impression that, oh, SARS Summit takes 40% of my profits. They take it and it's theirs. That's capital gains tax. No, it's not. They take 40% of your profits and they include that in your income tax. So whatever rate your income tax, the percentage is that your rate of income tax is, you will pay that percentage on the 40%. So you don't pay 40%, you get taxed on 40% of your net profits. So there is a quick example. So if you have a look at the maximum income tax rate that individuals can pay times 40%, it works to 18%. So that's just a quick way. Forget about 40% and the rate of income tax. If you look at worst case scenario, your seller will have to pay 18% of his net profits, 18% of the R1 million, well, 18% of the 400,000 Rand. So, no, sorry, of the R1 million. So 18% of the R1 million. So he will have to pay 180,000 Rand. So in that scenario that we used, 400,000 Rand was the 40% of his profits. 400,000 Rand was included in his taxable income. If he sold Kersner or whoever, and he has the highest income tax bracket, he will then have to pay 180,000 Rand from the 400,000 Rand to SARS. So the easiest way to calculate is 18% of your net profits will be taxed, will be your capital gains tax that must be paid to SARS. If it's a company and a closed corporation, SARS wants 80% of the net profits to be included in the taxable income of the company or closed corporation. So if the company or closed corporation made a net profit of R1 million, SARS wants them to include 800,000 Rand into their taxable income. And if you have a look at the rate of tax companies of closed corporations, the easiest way to then calculate it is 22.4% of the net income. So 224,000 rand of the million rand profits that the company made will be paid to SARS. If it is a trust, it's 36% of the net profit. So if the trust made a million rand profit, 360,000 rand will have to pay to SARS. That is capital gains tax, because for a trust as well, 80% of the net profits will be included in the taxable income, and the trust will then pay tax on that, and that is 36% all inclusive. So capital gains tax, just to give a couple of little examples. So let's say, for example, the proceeds of the sale is at 1.5. I sell my property for 1.5 million rand. The base cost of the property when I bought it, it was 1 million rand. So my profits or capital gain is 500,000 rand. Now, obviously, how do you determine the base cost? Because it's the original purchase price, because I might have only paid, let's say, 800,000 rand for the property. But I also pay transfer and bond costs in order to get the property into my name. So those costs can also be included to get to the base cost, because those were costs. So I can deduct that from my net profit. So let's say it was 100,000 rands worth of transfer duty and bond registration costs, and a little bit of maybe renovations that I did to the property. And when I sold my property, it was another 100,000 rand. So the property cost me 1 million rand. I sold it for 1.5, so my net profits is then 500,000 rand. So if it's not my primary residence, SARS will then say, well, then 40% of that 500,000 rand must now be included in your taxable income. Or we can just quickly use and say, well, 18% of the 500,000 rand, that will be my total worst case scenario capital gains tax that I must pay over to SARS. And if it's a company, then obviously it will be the 22.4% of the 500,000 rand. And if it's a trust, it will be 36% of the 500,000 rand will then pay over to SARS as capital gains tax. So base cost determination, as I said, you have a look at your original purchase price, the transfer and bond costs that you had to pay to get the property into your name. If you did any extensions or renovations or improvements at the property, your seller must keep those slips. He must keep the invoices, proof of payment. He must keep it so that he can go and show SARS. But SARS, you can't tax me you've got to deduct what I spent in renovating the property. You know, I redid the kitchen, I redid the bathrooms, I did all those things. I spent 150,000 rand there. SARS will say that's absolutely fine. You can deduct that from your net profits because you had expenses there. You improved the value of the property in order to get to 1.5, because if you didn't do it, you might have only gotten 1.2, 1.3 million rand for the property in any event. So you deduct that. So if you did renovation, you can take that into consideration. That can be part of your base cost, what the property cost you. Obviously, timing, it's just whether or not the property was acquired before or after October 2001, because when capital gains tax came into operation in 2001, SARS said, look guys, it's new legislation, so even if you owned the property since 1980, get a value of the property as at October 2001, because that's now going to be the starting point of the value of your. It's as if you purchased the property in October 2001. What's the value of the property? Because now we're going to have a look at the growth in the value of the property as from October 2001. We're not going to look at the growth from 1980 since you owned the property. That's unfair. We must have a look at the growth in the value of the property as from October 2001. What's the growth in value here? And that we will then tax you on based on whether you made a capital gain or not. So there are methods, you know, if a seller did not get a valuation done to show what the value of his property was in October 2001. There are the time apportionment method, etc. But the financial advisors will advise them about those things. And obviously, there are subtractions from the base cost as well. Your first 40,000 Rand example of capital gain is exempt. So let's say you made 100,000 Rand net profit, 40,000 Rand. So I says, well, the first 40,000 Rand you can take off as well. So just then pay on the balance of 60,000 Rand, the capital gains tax, etc., etc. So yeah, so there are certain rebates and reductions as well. And the main rebate is obviously if you are selling your primary residence where you reside. Then SARS says, well, look, you know what? Your first 2 million rands worth of net profits is exempt. We're not going to charge you on your first 2 million rands worth of net profits. We won't charge you. So if you bought the property for 1 million and you sold it for 3 million for argument's sake, there's no capital gains tax payable because your profits are not more than 2 million rand. So you don't have to pay any capital gains tax to SARS if you sell your primary residence where you reside and if your profits are not more than 2 million rand. Obviously, if you are lucky and you made more than 2 million rands worth of profits, you will then just pay capital gains tax on the balance. So let's say, for example, you bought the property for a steal. It was your primary residence and you sold it for 3.5 million rand. Let's say your capital gain or your net profits after you've deducted renovations and agents' commissions and costs and is, let's say, 2.5. SARS will say, hey, was this your primary? Yes, it was my primary residence. Well, okay. So you made 2.5 million rand net profit. That's brilliant. 2 million rand, you can keep. That's yours because it was your primary residence. So we're going to charge you capital gains tax just on the 500,000 Rand there. So that is the major rebate if it is your primary residence. If it is not your primary residence, obviously you will then pay capital gains tax on all the profits that you've made. 40% will then be included in your income income tax, and you'll pay tax on 40% of your profits. 18% of the 500,000 Rand, or 18% if it wasn't your primary residence, on all the profits that you've made. And obviously, for a company or a closed corporation, they don't have a rebate like that. That rebate, primary residence, only apply to private individuals, Hein or Susan or Michelle, whoever. It does not apply to companies, closed corporations. So even if the company bought a property to use as a residence for the directors, the two directors, husband and wife of the company, they stay in this property. Or the closed corporation, the two members of the closed corporation, SARS says it doesn't matter. If a property is in the name of a company, a trust, or a closed corporation, there is no rebate. It's only if it's in a private individual. So the company, closed corporation, and trust will have to pay tax on all their profits. They don't have a 2 million Rand rebate, despite the fact that the directors reside in the property as their residence or it's irrelevant. There's no rebate for companies, closed corporations, and trusts like there is with a private individual that sells his primary residence. It's only him or her that will have that 2 million Rand rebate on the net profits. So now we know what capital gains tax is. So now we can get to the withholding tax. So as we know, capital gains tax is payable on the net profits that you make, only on the net profits that you've made. If it is your primary residence, then 2 million Rand is exempt. If it's a company or closed corporation or trust, 80% of the net profits will go into the taxable income. If it is an individual, then 40% will go into the taxable income. So what SARS realized is that, look, when non-resident people sell properties, like for example, the owner of the property stays in the UK or Australia or America, what SARS realized was these people sell properties here in South Africa. They take their money and they duck. They never come to SARS to do their tax return, to show SARS, here's the 40%, here's the 80% if it's a company or whatever. So this is the tax that I owe, this is what I'll pay. Foreigners sold properties, took their money, and ducked out of the country. So that is why SARS said, no, hang on. We've got to stop this. We are losing out on capital gains tax. So SARS said, you know what, Mr. Seller, if you are non-resident, if you don't stay in South Africa, first of all, obviously this property that you are selling cannot be your primary residence. So even if it is in a private individual's name, you will not get the 2 million rand rebate because it is impossible for you to sell this as your primary residence if you are not even a resident of South Africa. It's impossible. So you will have to pay capital gains tax. So SARS then said that, look, we have to make a plan to recoup these taxes that we are losing out. So that's why SARS then made a rule to say, look, we're going to put an obligation on the conveyancers, the estate agents, and actual fact the purchasers as well, that when you buy, Mr. Purchaser, a property or any asset from a non-resident, the duty is on you as the purchaser to withhold certain money from that seller and pay it over to SARS. Because we as SARS want to make sure that we get the tax which is due to us, which the seller should be paying. But you know what? In the past, they took their money and they ran overseas, never coming back to South Africa, never paying their capital gains tax. So they're laughing at us over there in the UK, wherever. So SARS said, no, stop it. So if you're a non-res, we're going to now force you to do your tax returns. We want you to do your tax returns. So SARS set out the directive, but only for properties that are sold for 2 million rand. I suspect SARS is saying, look, we're not going to deal with small fry. You know, if you're a non-resident seller, you don't reside in South Africa, and you sell your property for more than 2 million rand, excuse me, then certain percentages
You okay, hon?
Okay, let's try again. The frog in my throat is out. Okay, so SARS is saying that, look, if you guys sell properties for more than 2 million rand and you're non-resident, then certain percentages must be retained. So if you're a natural person, 7.5% of the selling price must be retained. If you're a company or a closed corporation, 10% must be retained. And if it's a trust, 15%. And that retention amount must be paid over to SARS within 14 days of the transfer being registered. The liability to do so is on the shoulders of estate agents, purchasers actually as well, and the conveyancers. So a lot of non-resident people, when they saw this, they obviously said, yes, you know what? Your South African government is robbing us. Hulle steel ons broken. That's not the reason for this. SARS just wants the people to come and do their tax returns. So this now gets SARS's hands on some of the proceeds of a sale, and they've now got it in their kitty, in their wallet. So they would say, Mr. Seller, non-res, come and do your tax return. Come and show us that you don't owe us 7.5 or 10 or 15%. If you don't owe us that amount of money, you can have whatever the balance is, you can have it back. But come and do your tax returns. Otherwise, we're going to keep it. So we want to force you out to please come and do your tax returns. So that is why very often we deal with non-res sellers, obviously, that sell their property for more than 2 million rand, we then advise the seller, Mr. Seller, you're non-res, you don't reside in South Africa. So capital gains, you don't have a rebate of 2 million or nothing like that. And you sold your property now for more than 2 million rand. You must just know, we have to keep 7.5% of your selling price. We've got to keep that back and pay it over to SARS within 14 days after the transfer is registered. Then obviously they say, but man, we bought the property for 2 million. We only sold it for 2.5. You know, there's agent's commission, there's costs, whatever. I'm only making like 100,000 rand, and now you're keeping 250,000 rand. Come and do your tax return. So the seller can, before the transfer is registered, he can get a tax directive from SARS. We can instruct an accountant to say go to SARS and say, SARS, yeah, I want a tax directive on behalf of the seller. Here's what he paid for the property. These were the costs. These were the renovations. This is the selling price. This is the agent's commission, etc., that he has to pay. Blah 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 blah. So then the SARS will come back and say, great, thank you. So we will then get a letter from SARS to say, STBB, please don't retain 7.5% of the selling price. Sometimes the seller doesn't owe SARS anything because he didn't make a profit. SARS will then say, don't keep any money back from him. Zero. Give him his proceeds. Or SARS will come back to say, oh, I've got a tax directive. This seller, despite the fact that he sold the property for 3 million, whatever, don't keep 7.5% of the 3 million. Only keep 10,000 or 15,000 rand because the accountant came to do the tax return. And the seller's liability is only 10,000 rand or whatever. So just you as the conveyancers, don't keep 7.5% of 3 million. Keep 10,000 rand and pay the 10,000 rand over to us. We're happy with that. So sellers must understand, SARS is not trying to nail them by taxing them 7.5 and 10 of a selling price. Not at all. SARS wants to force these sellers to come and do the tax return. Come, show us. If you don't owe us anything, you can have your money. Go. Obviously, if the seller doesn't do that, he doesn't get his tax directive from SARS to show to the conveyancers what to keep back and what not to keep back. He can do his tax return after the transfer has taken place with his normal tax returns. And again, he will do his tax return, show SARS what he owes. SARS will come back and say, hey, you know what? That 7.5% that we received from the conveyancers, let's say it was 100,000 rand. We've got that, but you know what, Mr. Seller? Thank you for coming to do your tax return. Thank you. We can see that you actually only owe us 50,000 rand. So you know what? We've got 100,000 rand. Here's your 50,000 rand back. So we'll give you your money back, but we want you to come and do your tax returns, because if you don't get the tax directive before the transfer or come and do your tax return within that year, you know what? Then we're going to keep the 7.5, 10 and 15%. And maybe that's a bargain for you. Maybe you owe us more than 7.5% of the selling price. Well, it's fine then. At least we've got something. At least we've got 7.5%, and that's ours now, if you don't want to come and do your tax returns with us. Then estate duty. So estate duty is the tax that the deceased estate will have to pay on the value of the estate of the deceased person. Estate duty is calculated at 20% for estates below 30 million and 25% for estates more than 30 million. But you'll see there are so many deductions in an estate that it is very seldom. I actually spoke to our Claremont branch the other day. They deal with estates on a daily basis. And they said it is so seldom that an estate is liable for estate duty. And we'll see why. So what the Estate Duty Act says is that 20% below 30 million and 25% above 30 million, that is charged on the dutiable value of the estate. What is the dutiable value of the estate because it's like your net profits. So like when we work capital gains tax out, we can deduct the original purchase price, the renovations, the agent's commission, you can deduct all those things and you get to a net amount which you pay capital gains tax on. Estates, it's very similar. You also work out where you come to a net value, and estate duty is then payable on that net value of the estate because there are so many allowable deductions that you can deduct from the value of the estate in order to come and see, to be able to then see, well, what is the dutiable value of the estate? What can we as SARS now charge 20% or whatever on? So, for example, if you have a look at the value of the estate, certain things can be deducted. Like, for example, the expenses for advertising the estate in the government gazette, etc. Funeral costs, the estate administration cost, the cost that it costs for the executor, because they charge 3.5% of the value of the estate, that gets deducted from the value of the estate because that's a cost. The administration costs, claims from a surviving spouse. So if my surviving spouse, let's say the spouse inherits assets, the assets which a surviving spouse inherits gets deducted from the value of the estate. It doesn't get taken into consideration. Again, if parties are married in community of property, the husband passes away. Now it's a joint estate. They've got one estate because they were married in community of property. The first thing is the surviving spouse has already got a claim for 50% of that estate. 50% of it must go to her. So that gets deducted from the value of the estate. That doesn't get taken into consideration to make up the value of the estate. If the husband and the wife, for example, were married out of community of property with the accrual system, and now one passes away, if the other spouse had a smaller estate and he's got a claim now, that claim that the surviving spouse has against the estate gets deducted. It doesn't get taken into consideration to calculate the value of the estate. And the most important one is obviously assets which was bequeathed to the surviving spouse does not get taken into consideration. And how often does a will not state, if I pass away, my estate goes to my wife? That's it. Well, then, what is this estate costs and all those things? The cost of the transfer. So if a property has to be transferred to the surviving spouse or to a beneficiary, it is the estate. Yes, there's no transfer duty payable to SARS. We know that. But there's still an attorney that will have to attend to that transfer. And there are still fees, attorney fees, to go and register the transfer at the deeds office. All those things are deducted from the value of the estate because the estate is actually liable to pay those costs. And then there's also a rebate. So the same as what you've got a rebate with capital gains tax of 2 million rand on your profits if it's your primary residence, there's a rebate of 3.5 million rand. So the first 3.5 million rand value of the estate, whatever is left over. So after you've deducted whatever the surviving spouse inherited, all the costs, all the administration costs, all those things, once you've deducted all of that, there's a further rebate of 3.5 million rand. So you only get taxed on whatever is then still left over after the 3.5 million rand has also now been deducted. So that's why the Claremont office said it's very, very seldom that an estate is liable for estate duty because there are so many things that you can deduct from the value of the estate in order to come to the net value of the estate that the estate can be taxed upon. So estate duty, it obviously relates to any land. The value of the land will be included in the value of the estate. But I mean, if the land goes to the surviving spouse, well, what's the point then? She inherits it. It doesn't form part of the duty bill. But anyway, what is considered is the value of land or usufruct or deemed property. So an SA resident obviously that stays in South Africa. If he has property overseas, that overseas property will also form part of his estate. So it's not only the property if he's a South African resident. It's not only the property in South Africa that will be taken into consideration to calculate the value of the estate. It will also be the property that he owns in the UK or Australia that will also form part of his estate. If it is a non-South African resident, if the person does not reside in South Africa, obviously SARS will then only look at the property that he owns in South Africa. If he doesn't reside here, they'll only include the property that he owns in South Africa into his estate, not the foreign assets whatsoever. And then obviously living annuities in some cases, we'll get to that as well. If, for example, a beneficiary is not named in a life policy, then that policy will pay into the estate. If there is a name or a beneficiary in a life policy, that policy will pay to that beneficiary, and that policy amount will not form part of the estate either. So the exclusions from the estate, certain assets are not part of dutable estate, such as pension funds, etc. Provident fund. Our electricity just went off again, guys. So if I do lose you for a minute, I'll be back very shortly. So we'll go back to Eskom power now, obviously. There we go. We are back with Eskom. Assets held in a trust. So a trust is a separate entity. So if a trust is created, the assets that will form part of the trust will not form part of the taxable income. Allowable deductions from the gross value of the estate includes the transfer fees that we discussed. You know, the estate is liable to pay the transfer fees if a property has to be transferred to a surviving spouse. And Section 4 abatement, or it's the 3.5 million rand that also gets deducted from the value of the estate. And there's a rollover possible, just saying that if the surviving spouse did not utilize the 3.5 million rand rebate that she was entitled to, that 3.5 will roll over, and the surviving spouse can then use a 7 million rand rebate when the surviving spouse dies. Donations tax, it's the last little one quickly. Obviously, you want to donate something, donations tax is payable. It's payable 20% of the value of what you donate. If it is less than 30 million rand that you donate, then 20% must be paid to SARS. If it's more than 30 million that you are donating, you have to pay 25% to SARS. It's normally in terms of a legal contract and donations agreement between father and son, or father and a friend, whatever it will be. So the donor will donate and the donee will accept the benefit of that donations. There are certain exemptions. If the donation is made to a spouse or it's made to a public beneficial organization that has been approved, recognized by government as a public benefit organization, and you want to donate 600 million to there's no donations tax payable. If you donate to your spouse, there's also no donation tax between spouses. You can donate whatever you want to donate. If the donor is a natural person and wants to gift something to his son or a friend next door, you can give 10,000 rand per year without having to be taxed thereon. So if you want to be friendly to a neighbor or your son or kids or whatever, you can give 10,000 rand. If it's your spouse, there's no limit. You can donate whatever you want. There is no limit. If you want to donate a share or a portion of immovable property, you can donate up to 100,000 rand in immovable property to someone per year. Who's liable to pay this tax? It's the donor. The person who is giving the donation must pay that tax. It's obviously, I think, normally also the same as transfer duty, those taxes within 6 months after the donation. The only thing is that if the donor, person giving the donation, doesn't pay that tax, then the donee, the person who received it, SARS will then go to them and say, right, you must now pay the tax. So you are now also liable because the donor didn't make payment of the donations tax. And guys, that is it. Other than the frog in my throat, yes, so you can donate every year 100,000 Rand on the same property. Absolutely. The only stuff up there is that you can donate 100,000, and then obviously until such time as you've denoted, maybe in 10 years' time, you donated the total property of R1,000,000, and then obviously no transfer duty or anything like that was payable because you donated it to whoever. So yes, you can donate every year 100,000 Rand on the same property until the property, obviously the value is R1,000,000. You donate 100,000 Rand a year for 10 years, and then the property is the new person's property. Hello, Bethlehem. Hello, Almo. Micheliki, thank you so much, man. I really appreciate it.
Thank you, Hein. Thank you for sharing your insights. I think that's it's made it very clear on a lot of levels. So thank you so much once again for doing the session for us.
Absolute pleasure. I'm out of here and enjoy your meeting. I'm switching out right now. Bye-bye.
Pleasure, Hein. Bye.
Bye.
Okay, good.